Welcome to the Money Insights Podcast, where high income earners come to learn wealth building strategies that will take them from high income to high net worth. With your hosts, financial and wealth building experts, Christian Allen and Rod Zabriskie.
Hey, welcome everybody to today's live webinar. We are talking live with Mr. Economy, David Perez, aka Mr. Economy, one of the leading tax strategists in the country. We're super excited, and I'm excited because we have a good group of people who are interested, focused. They want to figure out what to do with their taxes. So I think it's a really good thing. David, thanks for being with us, my friend. Couldn't be more excited to have you.
Well, I'm excited to be here, guys. You guys are always doing big things. I love getting around you two because you guys are always pushing the envelope when it comes to educating people. It's so cool to be around you. So thank you for having me.
Thanks, man. So let's see, how long we've known each other for like maybe 4 or 5 months now. And it feels like there's just been,
man.
Maybe it's been longer.
It feels that way,
okay,
yeah.
You're right.
I feel like we met, I'll be honest with you, I feel like we met last year around this time. I could be lying to you, but I feel like that's it.
It could be. You could be right. Time flies. But here's what I know is that, David, you put out tons of really good stuff. One of the things I like about creators who are willing to give away their interesting stuff, it's so valuable. And I've been following your stuff. I think that our audience today is going to get a ton of value from it. So we're just going to dive right into questions if you're okay with it.
Yeah, man, whatever. Throw them at me.
Let's do it.
I'll dodge I'll try to catch the good ones and dodge the bad ones. How about that?
Okay, that sounds good. That sounds fair. I did make a promise that I was going to ask the tough questions, so I'm going to ask the tough questions. Okay, so let's just get things kicked off with maybe the stuff that we have to cover. We'll get into the more fun stuff here in a few minutes, but let's get into some of the stuff we have to cover. First of all, just generally speaking, what's your take on how the election affects taxes for high income earners specifically?
So it's funny you asked that because in the media in general, it's this polarizing left and right? And we obviously can probably distinguish which one apparently is towards the business high income versus, the everyday middle America. I would say, very simply put, doesn't matter who wins. Doesn't matter. Because there's always going to be a way to mitigate taxes. And the reason that is because we don't vote on what passes from Congress. Congress, we don't vote to tell Congress what laws to pass for taxation. We don't vote on that. Congress makes those decisions, and we elect congressmen and women, but those people go in and they make their own decisions based on their wants, their needs, their desires. And all of those people have aspirations to be successful, to make money. They didn't run for office because they cared. I'm sorry, but
it's not just an altruistic, there's probably a few of those out there, but for the most part, I think you're right.
I mean, yeah, there probably are. It's probably the 80-20 rule, right? 80% of them are there because they want to promote themselves to another level of income, wealth, status. And there's probably 20% that are there to do good. Well, that 80% will always vote for things that will favor themselves. And so that means it will favor things like investments that give tax favored benefits, deductions and credits for high income earners and corporations, because they themselves participate in the same system we do. So I don't see a world where we will have just no tax loopholes ever again. It's always just going to be a different way around it. A good example, though, would be in the current administration, what's in current place with the Inflation Reduction Act, which didn't reduce inflation, but anyways, that's what it was called. Right. There were so many nuanced loopholes for clean and green energy, even though maybe not everybody's a supporter of that. If you want to benefit from the tax code, just put your money in that and you get the benefits from it. So there's always going to be a way. We may not necessarily align with, I like what I'm doing, but I want the tax savings, I'm going to do it. And so I don't think whoever wins is going to really dictate our tax strategy. If there is a strategy, it's more so what the strategy becomes.
Yeah, that makes sense. So one of the pieces of, maybe I shouldn't say advice. We don't give financial advice in general, right? So, but one of the urges that I told people is to maybe not worry so much about the outcome of the election and focus on the investment opportunities themselves. Because most often, even if the things are on the table, like how often do those things actually pass and become law? So like to go out there and start to change and pivot on my investment strategy for something that may or may not come about, like that's probably putting the cart before the horse, in my opinion.
I have so many people who reach out to me and say, well, I need to make some changes before the end of the year. And I agree at some level we should have that much of a preparation, but I mean, we can't predict the future. We can only control what's going on right now. And so we have to make decisions based on the information we have that is true and current versus those that are projections or predictions. Because if we do that and it doesn't work in our favor, then we just we just got to do the thing that makes sense now. And so a lot of people are getting a little anxious. And I wouldn't be there right now. What I would be saying is like, okay, let's just deal with this one problem at a time. At December 31st, clock hits midnight, January 1, we have a reset. Whatever happens that year, we'll figure it out that year. Because that's how taxes are calculated. They're calculated on an annual basis. Like one bad move will not ruin your whole life. The good thing is like if you're strategic and you plan and you have a good financial team around you, they will tell you just one thing at a time. One thing at a time. We can't be wealthy overnight. Like it's just not going to happen that way.
Yep. I love it. I love it. Rod, what's your first question for Mr. Economy?
Yeah. So my first question is that a lot of people have a CPA, but a lot of times they feel like they're not in their corner. They're not like really working in their interest in helping them create tax savings. Yep. Why do people feel that way?
Well, there's three real reasons why most accountants, professionals, they just don't help their clients at the level that their clients want. There's three reasons. And it really just comes down to number one. Number one really relies on that these guys are just overworked. You have to, that'll kind of tie into number two. It's really, actually, I'll just state it in a real simple way for everybody here. You don't pay them enough. They can't do it all because again, they don't have the time. They're doing 1,000 returns. How do they spend the time and energy to help you accomplish that? So 1 and 2, there's three reasons. 1 and 2 are very similar. It's like you don't pay them enough. And because you don't pay them enough, they have to take on a lot of clients. If they have to take on a lot of clients, that ties into number 2, which has a lot of work. And so you can't expect somebody. So the national average for tax preparation today is about $250. Like that's the average fee that somebody collects to prepare a tax return. So a tax professional collects. To do just to make $100,000. Think about that. To make $1 million, they have to do 4,000 of those. Okay, so so like it's 400 to get there. It's such a ridiculous amount of clients to make real money that if you are going to them to save your tax problem, they're like, bro, I don't have time for that. Unfortunately, it's kind of both your faults. It's their fault for not saying, hey, pay me more. And it's your fault for not saying, what is it going to take to help you get me to this level? So it's those two things. And the third thing is the reason that they don't know what to do or how to do it is because they don't have that problem themselves. And most accountants, they don't have aspirations to make a bunch of money or to become very successful or build wealth. Their definition of wealth may be small in comparison to yours as an ambitious person. And so if they're never going to encounter the same problems, then you're going to be disappointed every year. Like I tell my clients all the time, I'm my client. Every year I'm looking for the next thing for me because I make significant amounts of money and I'm not shy about it. And I'll say, hey, I've got to mitigate a liability. I got to figure it out. When my net income is well over 7 figures, I have a problem. I just filed my 2023 return just a week ago, like about a week ago, and I got a $20,000 refund, and I still reported 1.3 million in net income rather. Like I still showed 1.3 is what I netted, and I still got a refund. Like think about that.
That's wild. That's wild. I have not had that problem of getting refunds. I'm going to tell you that much.
Well, we got to work together. I can help.
So we're going to be talking more. That's for sure. Okay. So here's a question I think that most people will have. Like, we hear about kind of the typical things that people can do to reduce taxes. Like, or I say reduce taxes, I want to put that in air quotes because it's oftentimes like putting money in a deferred comp plan or 401k or those kind, deferring money for some future time. That's one of the things that, from a Money Insights perspective, we would tell people it may be valuable at certain situations, but it may not. But maybe talk a little bit about what's different about the kind of things that you're doing to help people slash their taxes versus kind of what they typically see out there in the marketplace.
Yeah, so we would first and foremost, there's a lot of a misconception about tax strategy. Is that a lot of the times I think most people just think about expensing to zero, and so what I mean by that is if they are a business owner, they get to buy things, use the money in a way that it would get them lower to the 0 point, and hopefully that pays no taxes. And that means that in that case, anybody who's a W-2 earner would say, well, then this doesn't work for me. So that's always been the case. Well, the challenge with that is that most recommendations out there are like, just buy a vehicle or buy some more stuff and your upgrade your office, or invest in some sort of thing that makes your business more better. And like, all those are great things. The challenge with that is they all reduce your taxable income by expenses. And if you reduce your income by using expenses, you literally are expensing to zero. And so then as a business owner, W-2 earner, whatever it is, whichever you are, when you go to try to borrow money, let's say to buy your first or next home, or you want to expand your business operations, or you want to do something that requires financing, you're going to look poor.
That's a problem, right? That's been me, David. Sorry to cut you off, but I'm living that experience. I'm building a big old house. I'm really excited about it, and so I'm like, I don't feel like I can use some of the tax strategies right now because I need to make sure that my income's still high for the loan element. So I'm glad you brought that up.
Yeah.
And I think a lot of people feel that. Well,
the way real strategy works is you look rich to a bank and poor to the IRS.
Yes, that's the way to do it.
That's the strategy. So typically that means that you don't go to this expense to zero, you invest to zero.
Mm.
And if you invest to zero, then usually when you invest, you're getting some sort of either credit or deduction. If it's a deduction, the deduction comes in the form of depreciation. Whenever you get depreciation, that gets added back at the financing table. So you could have $1 million in depreciation, and that takes you to zero, meaning you show no income. But when I go to buy my next property, I go to the bank looks at that line item and says, oh, you had $1 million in income. I'm like, yes, I did. They're like, oh, you're one of those guys that pays zero taxes because you show nothing to the IRS, but you show everything to me. Okay, cool. Well, good for you, bro. And you can borrow wherever you want.
Does that really work?
Yes. Every day.
I love it. I'm saying that I'm just thinking like, I think you're describing exactly what most people want, right? And so there's a few problems that have gotten in our way of actually accomplishing that. One of them is, I think, one of those things is like just maybe not believing, like, is that really true? And number two, struggling to find the right person to go to. So here's a question I had as a follow-up to what you said earlier, David. Do some of these, or do the CPAs that people are talking to actually know how to do it? Let's say they had the time. Do they actually have like the know-how?
I would say 9 out of 10 don't. Yeah, and a lot of the reason is because it requires them to. So let's step back. The reason that they don't have it goes back to the reason number 3 why they're not doing it is because they've never had the problem. So or have encountered somebody with the problem. So they've had no ambition or maybe even no insights as to what I'm supposed to look for. Right? Because I would call 9 out of 10 CPAs or accountants or whatever their designation is, I would classify them as blind patriots. They are people who believe that there is a reason why you should pay taxes. They are people who believe that they work for the IRS and not for you. And by the way, I don't think that they're just evil people. I just think that there's this belief that if you don't pay your taxes, well, this country can't run. And unfortunately, it's running right now without enough tax dollars. So if I don't give you any of mine or not, I don't think that has any bearing on any success of this country. And
well, and there's more ways to push it into the economy than just through taxes, right? We can push it in, we can put money into the economy and help growth and help the economy besides just paying more taxes.
Well, the way that you get tax benefits, savings rather, it comes through investments. And those investments are typically in things that the government wants us to do. Open a business, fund energy, fund your retirement accounts, right? These are things, housing. There are things that the government says, if you do these activities, we would gladly reward you with some tax benefits because you're actually stimulating the economy as a whole. We're not trying to, by the way, by no means am I telling you don't pay taxes, just keep all the money. No, you can't do that. You've got to get the money and invest it somewhere. You have to. Number one, not just because I'm telling you, it's because that's the only way tax strategy works. And secondly, it'd be dumb to just take your money and go on vacation.
Yeah,
you did not pay taxes to do something, right? Like you need to build wealth with it. And that's the way you build wealth, because if 30% of your money, 30 to 40% of your money over the course of your life is going to go to some form of taxation, then if we can keep 30 of it, or, like all of it, or half of it, do something good with it. You're going to employ more people if you're a business owner. You're going to put more into your savings if you're a W-2 wage earner. You're going to do something good with it. I know you are, so do it.
Yeah, I love that idea. So I'm just thinking about it, right? If you're $1 million earner and you're paying 30% in taxes, like even if you cut it in half and save 150 grand a year that's now working to build instead of going directly to the IRS, like that is a massive difference, especially as you bring that out over time.
100%, 100%. And by the way, if you've got 1.2, if you're going to show $1.2 million or less right now to the IRS, unless it's capital gain, I can get you to zero like today. You don't have to pay taxes this year.
That's wild. That's wild. So here's the call to action is, if you're someone who wants to pay zero or you want to get your taxes down, like genuinely, we got to get you talking to David. In fact, while we're talking, we're going to have a link go up that's just going to have your scheduling link. So anybody that's listening that wants to get on David's calendar, his team's calendar, you can find it in the comments. I believe your team is putting it in there now. Sweet.
There it is.
Thank you.
Okay. Sorry, Rod. I'm hogging all the questions.
No. This is meant to be a conversation. We want to be so much more like
link only goes to host and panelist. At least it says. I don't know if I found myself restricted too. Maybe you guys could grab it and post it to everyone.
Sure. Yeah.
Oh, yes. Okay. While you're doing that, Rada, so you've worked, David, with tons of clients, reducing tax bills. Without getting into a lot of detail, like what are some of the most effective strategies you've implemented that really are making a big impact with your clients right now? Well,
number one has always been real estate. And because I'm a real estate guy, my wife and I have acquired real estate over the last, so we've been married 5 years. Over the last 5 years, we've acquired quite a bit of properties. I started back in 2011, but as of today, we own about $10 million worth of real estate, from multifamily, commercial, single family. Anyways, and awesome. That's always been my strategy. And unfortunately, though, over the last 2 years, that strategy has been impacted by some phasing out tax code. So it's called the Tax Cuts and Jobs Act of 2018 was a very good stimulus to our economy and had a very big impact on tax deductions for real estate investors. And the phasing out of that is happening right now. And because of that, the benefits from real estate investing aren't as sexy as they once were. So I can tell you that real estate is great and you can continue to do that. However, it may not give you the biggest bang for your buck. So I actually have an alternative strategy to that is very similar. So imagine instead of buying real estate, you could buy a heavy asset, like let's say equipment. Equipment is one of them. Mm-hmm. So you could acquire equipment. Let's call it I don't know, big backhoes or scissor lifts, or some big heavy equipment that you would see at a rental facility. So imagine buying heavy equipment and utilizing that as a depreciating asset that could give you a huge tax deduction on your return. Now, the reason why I compare it to real estate is because you could buy, let's call it a $500,000 real estate property or $500,000 in equipment. Both same 500,000, except 500,000 from real estate would equate to about 80,000 in a deduction if you use cost segregation study.
Okay.
If you do all these things, I'm just skipping all the math for you. But equipment is 500,000. You get 500,000 period. Like you get that. Now you're probably like, why would anybody buy equipment? What if I told you that one of our strategies is we've partnered with one of the largest equipment leasing companies in the country, and they have given us the authority to work with clients where we can actually have our clients purchase equipment and they will lease it from you, take it and put it into pools, and actually take that equipment and make money with it and pay you every month a rev share.
That's cool.
You get a rev share. By the way, it's 18% right now, rev share. You get 18% on your money. Plus
and
a $500,000.
sorry, keep going.
And plus a $500,000 deduction.
Okay, well, that is pretty sexy. Like that's something that I think people can get behind. Okay, here's the only question that's coming to my mind. Maybe you can kind of help people put their mind at ease.
Yeah.
A lot of people have been investing in real estate, multifamily real estate specifically. Like our audience is very much a multifamily real estate audience.
Me too.
And it's been great. It's been like we've crushed it for a decade, right? However, there has been more concern. I sense that people are more hesitant to let go of their capital right now because of some, over the last maybe year or so, some of those real estate deals that haven't gone as well. So in a situation like that, the only concern I have as a person is like, well, how do I know the actual investment's going to work? Is it with a good company? That kind of thing.
Question. So the company we partnered with is the third largest equipment rental business in the whole country. I'll just say the name. They're called Equipment Share. Equipment Share. Cool. They're the largest. They're the fastest growing too. But so I'm a real estate guy. If I could find deals. So by the way, we've got two large apartment complexes that we own. One of them is 83 doors. Another one is 120 doors. So we have 220 doors in large units. Like the challenge there, just to be clear, for those of our listeners who are in real estate, number one is you may not even be benefiting from those type of investments because you're not an active participant. You're usually a passive investor. If you're a passive investor in these activities, that even they could spit out $1 million loss to you. It would not offset any of your income because passive and offset active income. So investing in real estate is a great thing. The challenge is if you're not a general partner and you're not in operations, it doesn't even matter. Like you're only investing for the benefit of the investment, which is amazing. Don't get me wrong. Right. You're just not getting the tax benefits. In this case, by the way, and if you were to do it on your own, like real estate, you would go into any deal 20% down, for an example. So if you bought equipment, if you bought a piece of real estate for $500,000, you'd have to put $100,000 out of pocket. Okay. And you would only get about an $80,000 deduction for that $100,000 down payment, which it's not $80,000 isn't a reduction in taxes. It's a reduction in income. So you're still out of pocket a lot of money.
Yeah.
Whereas with equipment, we have banks that'll finance that with 10% down, $50,000, and you get a $500,000 deduction of income.
That's incredible.
So it's a better strategy this year. Now, I can't go into next year because I don't know, but let's assume that 100% bonus depreciation comes back in January. Oh, let's go. But what you could do is invest in this strategy, keep more of your cash, and buy real estate with those savings that you're going to get from taxes.
I love it. So, and it sounds like you're saying that you don't have to be somebody who needs a backhoe for your business or for your life. You're using that as an opportunity to depreciate or to reduce taxes and create an investment flow from working with that leasing company.
Amen. That's exactly what we're doing.
That's really cool.
Yeah. So that's an innovative strategy. Now we have a ton of strategies. Don't get me wrong.
Sure.
The reason I use that one is because it's the easiest to get because it's buying something. It would be very similar. So very similar. If you've ever owned a business or you've got business owners here, they always say buy an SUV or buy a big vehicle.
Yeah.
Very similar strategy, except when you buy a big vehicle, let's say you buy a Cadillac Escalade or a G-Wagon or whatever you buy, at the end of the year, it gives you a badass tax deduction. But January 1, it becomes a liability because you got a $2,000 payment now. And that doesn't produce any income. It doesn't do anything. So you could obviously buy stuff for your business that gives you the same benefits. However, you would never produce the revenue like this would. This is a return on investment.
Yeah.
I think about it as investment prior to the tax strategy, by the way. I always look at investments before the tax strategy. So this one fits.
I love it. Yeah, I mean that's obviously a lot more powerful when like you're taking one step when you're taking the 179 deduction, right? But you're taking one step to potentially do something there, but first you've got to come up with the money to do it. So that's money now that you can't pay your taxes because you had to pay to get the vehicle, right? And so in this way, you're getting the tax deduction, but then you're taking that next step and saying, "Hey, we don't just want it to be an expense, we want it to be money that's working for us and actually going to our overall goal, which is to build real wealth."
Correct. Correct. And this is an income producing activity. It's its own business and everything, which by the way, in years 2 and on becomes an actual opportunity for other opportunities. So like for an example, if I was a W-2 earner here and I don't own a business, this would be a business activity. We would form a business like an LLC. It would operate like David's Equipment Leasing Company. We would then buy the equipment, put it in the LLC, lease it out to this third party. And next year, we're going to use the Augusta rule. We're going to use paying your kids. We're going to use funding a retirement account. We're going to use paying life insurance. We're going to do all those strategies in your newly found LLC that you said all your life, I'm never going to own a business. Now you got one that you don't have to do anything to do. Like it's
okay. I love that.
Brilliant.
Sorry, Rod. Go ahead.
No, yeah, I just think that's brilliant. Okay, so we have a question that came in from Todd. He says, do you need to be an accredited investor to do the equipment share strategy?
Todd, great question. So
yeah, good question.
The answer is yes and no. And the reason why is we don't need to validate that you're an accredited investor right off the bat. If you have income over 300,000. So, let me step back. Actually, I didn't even say this. The minimum investment to do this is 300,000, which means that your taxable income has to be 300,000 or greater. So you're automatically an accredited investor if you do it at that level. Just so we're saying the reason is 300. The reason it's 300,000 is just because the equipment, like the company that we get the equipment from, is like we don't want to deal with anybody under 300,000. So that's their threshold. So you have to buy a minimum of $300,000 worth of equipment, which it's dollar for dollar against your taxable income. So you have to have $300,000 or greater taxable income.
Yeah, that's
awesome.
helpful.
Todd, thank you for that question. And anybody has any questions? Jay, I see your hands up. We don't have a mechanism to bring you in and hear you. So, but go ahead and drop your question in that Q&A, and we'll definitely get your question to David.
Okay, so the next question that's coming to my mind, David, you've been talking about starting a business in order, like you doing some of those things to create some real tax deductions. We have a lot of people that are listening that will be in like the medical dental space. A lot of them own businesses, but a lot of them, are like specialty surgeons who work in a hospital, and they're constantly hearing kind of the mantra that you have to have a business in order to like create a lot of deductions or create. So talk to us a little bit about that, just because I know that it's not that hard and fast.
So great question. So first off, medical professionals, specifically doctors, dentists, surgeons, you guys are perfect for the type of strategy I just recommended, not just because I want to stick to that one, but that since we just talked about one, great illustration of a strategy that's beneficial for them, because you guys are busy professionals, have a lot going on, high income, no ability to open a business, or maybe no ambitions to want to. I mean, I have clients, guys, that make over $1 million on a W-2. They're like dentists. And I mean, on a W-2, it's crazy. And I ask them, why don't you open your own practice? Because I won't, I don't want to deal with all that headache. I don't want to do all that work. And I'm making $1 million. I'm like, touche.
Okay.
Touche. Like, touche.
So you do you, right? Do it your way.
So those type of individuals who are in that position, I think you're perfect for tax strategy, especially strategies like the one I just shared, because it doesn't take a lot of time and energy for you to do these things. If you're a business owner already, obviously, then you understand the grind and it's easier for you to do it. But I mean, it doesn't take a lot of energy for anybody to do tax strategy, especially when you're working with the right team. And just for the sake of this conversation, so nobody gets me wrong, I'm not trying to tell you to come, make me do all your returns and all that stuff. In fact, that's not how I roll. Like, my job is to put the strategy in place and work with your existing professionals to execute them. Because you asked a great question earlier, which is, like, why don't their current guys know these strategies? It's because they've never been introduced. Let me introduce it to them. Let me show them what they can do for you, because that's our job. We execute, we implement, they come to us, we help you. Everybody wins. I mean, it's a great way to work.
Yeah, that's powerful,
Awesome.
right? It's a really great way to get you to the result you're wanting.
Yeah. I think I saw questions in here.
Rod,
Yeah,
do you want to pipe in with the questions, my friend?
yeah, we have a few more questions coming. People are really interested in this strategy, looking for a little more information on it. So Eric says, what happens to the value of the equipment over time? Does it depreciate to zero? Is it disposed of at a lower value?
Great question. So Eric, so in that particular strategy, what happens is when we sign the lease agreement with Equipment Share, which is the company that takes the equipment from us, they actually sign a 5-year commitment with a buyback at year 5. So at year 5, they're actually required to purchase the equipment back to you at a predetermined amount, typically 68% of the amount that is the amount of value at the time of lease. So you're actually going to get 68% back at year 5. Because same thing though, the reason it's structured that way is because the financing for these type of deals is typically a 5-year deal. So that's what happens. So they'll buy back the equipment at 68% of the time of the value at the time of
Very cool.
finance. Great
Awesome.
question.
And then I'm going to combine with a later question as well, because when you get that buyback, what happens to that? If you've been depreciating and all that, how does that 68% coming back? How's that treated?
So there's going to be a balance. So first off, usually that's 68%, and usually you're going to owe about 60%. So you're going to have like about an 8%, and that 8% is a variable just depending on the interest rate that you finance the equipment at. So you're going to get about 8% back in cash at the year 5. So you're actually going to get more money at year 5. You've been getting 18% cash on cash the entire 5 years. Okay. Now, when you do sell that equipment, you are going to have a recapture. So there is going to be a recapture, and that is a challenge that we'll have to deal with at 5 years. So
Yeah.
you get to keep all the money until then. So that's just something we got to deal with at year 5.
And then the natural question would be, in real estate, we have the 1031 exchange. Is there anything like that?
Not in equipment. So there is not a 1031 exchange. However, I will tell you this. Since what's going to end up happening is, let's say your tax bill is 100,000 at year 1, and so we mitigate the 100,000. At year 5, you're actually only going to owe 70,000 because because of the way that our expenses are going to work and buyback, it equivalents to about 70% owed. So you're going to have a 30% reduction anyways, plus we get to mitigate it at year 5. So it's not like you're going to do this. By the way, in real estate, you do have the same thing. You sell an asset early, which in most cases will happen. For those of you who are in multifamily, most multifamily business plans are 3 to 7 years, depending on the plan. And so you are going to have a recapture. Like everybody gets recaptures all the time. And
Yeah.
by the way, that's how people get you to stay in their deals because they're like,
Keep putting more money, then you get this, you do the same thing. So basically what you're saying, David, what I'm hearing you say is like proactive tax strategy isn't a one-time thing. In other words, I'm able to do this thing that creates some tremendous value, but I'm going to have to continually be active doing those kinds of things to continue to quote unquote kick the can down the road.
it always is that way. There's no way to wipe away your tax liability. It's just you're going to have to invest, and eventually that tax will come due. But we will always have something ahead of the time. Like you're not going to just be surprised one day. Like we can anticipate 5 years from now. We just got to plan, right? And it's okay. I mean, it's the same thing. Like for retirement. Like I know I need $5 million when I retire. I only have one right now. So what am I going to do? I got a plan. Let's just make a plan to get to that point. And if we don't get there, we got to have a few contingencies, but we're going to get there, right? That's just what it is.
Okay. Awesome. Yeah. Okay. Rod, ask maybe one more question on the equipment thing, but then let's move on from that.
Yeah. Sounds good.
I love it.
Yeah. So people are trying to get creative on getting to 300,000. So it's going to be a two-part question. Can you have like form an LLC and 3 different people pitch in the 100,000 each, and then that does it? That's question A. And then the second one is, with the 300,000, is that your down payment and you're getting the 90% financing? So it's $3 million worth of equipment. So that's part B.
Okay. So first question, partnership. That's a great effing question. Okay.
He bleeped himself. Nice work, David.
By the way, the real answer is no. Okay. Let me tell you why though. Because we're utilizing the short-term rental loophole on this. And so even if there's a partnership, only one partner is legitimately supposed to mature. Whoever participates the most in the activity is supposed to get the active portion of the loss.
Okay.
God.
However, this is just because maybe some of you guys want to do this on your own. You don't have to use me. The IRS would never really know which one the active partner is. Like if there's 5 partners, they wouldn't be able to know. Like I'm just throwing that out there. That's David giving you some under the table advice. Okay.
Perfect.
Now for the $300,000 investment, no. So 300,000 will buy you 3 million. 30,000 will buy you 300,000. So
you're saying you can get a $300,000 tax deduction with $30,000 down?
correct.
That's even more exciting. That's what I thought, but I just wanted to double check.
So just so we're clear, because I don't want, because people are going to love this, but there is a fee. There is a fee that partner that charges 3%. So you would actually need to pay 39,000, which is 3%,
Okay.
to get into that deal. So it's 39,000 to get 300,000 in a deduction. So it's again in an equivalent is it's 13% always of the number you want to mitigate.
I love it.
Let me add one more thing to that.
Yeah.
Because we're in, because somebody might want this strategy, and I didn't mean it to be all about this strategy. There's others.
No, that's great.
But
this is an exciting one.
okay, so this would be good to know is that every month between here and the end of the year, so we only have 2 more months, the fee to that company goes up by 1% because of urgency and the amount of work.
Interesting.
So,
okay. So
right
sooner
now
the better.
3%. Right now it's 3%. End of the month, November 1 begins, it's 4%. December is 5%. So if somebody wanted to use the strategy as somebody considering it, we should talk soon because it will go up. And the difference on 500,000 is right now.
David, we should talk soon. We should talk soon, David.
Because it's going to go from 15 to 25,000 in fees for a $500,000 deduction. So you want to do something.
Yep, I'm excited about that one. Can you just talk for a second? I know we don't want to get it delve into specifics too much, but can you talk about the STR tool that you talked about briefly on our webinar? Just a real 3-minute version of what that is, how it works.
You mean the STR loophole, right?
Yes. Yeah.
Okay. So short-term rental loopholes are a loophole's an unintended consequence. And so most people want to buy real estate as a strategy and they can't really benefit from it immediately because they aren't actively participating in the activity. Because the IRS has a definition for somebody who is just strictly in real estate. It's called a real estate professional. And it doesn't require a license. It doesn't require anything. It really just requires that you participate in the activity for 750 hours in a given year and that it's your main activity, which most real estate investors, that's not their main activity. They're doctors, they're dentists, they're business owners. So they can't meet that status. And if you meet the status though, you get to take the losses from that real estate and apply it at your other income. Most people can't meet that status. So a shortcut to that is to use short-term rentals because the IRS says if you have a short-term rental, that could be considered a business if you perform the following, which means you have to manage, maintain, or run, clean a short-term rental, a minimum of 100 hours in a given year. Make this activity the activity that you perform. Well, nobody else can participate in that activity more than you. That's 2 things you have to do. Just 100 hours and nobody else can do more hours than you. And to be defined as a short-term rental, it has to rent less than 7 days on average. That's it. And if you meet that criteria, then that loss that's going to come from the purchase of the real estate is going to be able to offset your other income. And that's why they call it a loophole because it's 750 or 100. 100's easier. Right? That's all it is. And so we use the same concept with the equipment because equipment leases 1, 2, 3, 7-day contracts. And so because of that, it qualifies the same principle applies to the short-term rental. We use it with equipment. Same concept.
I love it.
It's such a great, by the way, short-term rental, just between me and you guys, everybody here, if I was buying real estate, it's the only one I would use, not just because of taxes. It's because you can't make sense of any other deal unless it's a short-term rental right now.
Yeah, you're right. It is a lot more difficult to make all the numbers work, right? In the way that especially if we're trying to create the same thing that we had for the past decade. Doesn't work that way.
You cannot make money on a long-term rental right now. If you're traditionally financing it with 20% down, the numbers just do not make sense. Just don't.
Yeah. Okay. Sorry, Rod, what do you got for David?
Yeah, so maybe shifting gears a little bit, what's one of the most common mistakes you see high income earners make when it comes to taxes and how can they avoid it?
So common mistakes. First is accepting that whatever the bill is the bill. That's the most common thing. And I would probably actually, let me step back. I would say that the reason that most people accept it is because most high performers, high income earners work too much and they get caught off guard with these things. So the mistake is don't be too busy. Don't be too busy. Unfortunately, that's such a shitty advice. I hate to cuss, but it's just shitty advice, but it's the truth. Like this is one thing we're all not clear on, or at least most of the people I encounter, not everybody, but they're not clear on what the wealth number looks like to them. Like, because by the way, we can all define success as a quality of life or whatever you want to define it as, but the only thing we can measure literally is a dollar, a number. I mean, it's easy quantifiable. So if you don't have a quantifiable target and by a date that you need to have it, then that's why you're too busy. And that's really why most people lose out on so much money in tax savings because they just don't have a quantifiable number. They're not like, because if you knew that you had to hit this target in 15 years, you would fight every dollar that's going out of your bank account that doesn't need to be going, and you find a way because you will freaking hit it. But most people are just too busy being busy. They're just working, especially medical people, especially in the medical professions. Like, you know, the patient is more important, the clock is more important, the business is more important until they realize that April 15th, they're like, oh shit, I got this bill. I need to do something about it. And it's too late then. It's just too late.
So it sounds like the thing that you're saying here is like we have to be more deliberate from the jump, right? If we start if we start thinking about it and making deliberate decisions, like we can really make a difference on our tax from a tax standpoint, which by the way, when we do it the right way, that differentiation, that savings can go toward building wealth. But it never happens if we just show up one day and realize like we've got a $250,000 tax bill and I got to figure out what to do with it at that point.
Yeah. And by the way, you know, like some of the strategies you guys teach, I mean, imagine somebody who has a $500,000 taxable income this year. They're going to pay, depending on the state, let's just use 200 of it to taxes. 200,000.
It's insane, but that's right.
Okay. So they pay 200 grand. With our strategy, you would pay somewhere around 65,000 versus 200,000. They could take 100 of it and dump it into a policy or put it into a property, and they would get so much more money off of it. It's just incredible. And that wealth number, if they knew it, they could define and quantify, oh, this is moving me this much closer.
Yeah.
Like
we'll dump it into the policy, then into the investment.
Yes, because you could, you're right. You're doing it in a step and stages. Like you guys are right. Exactly.
Okay. I just want to make sure that I touch on this because I had someone asking me about it a little bit earlier, and it's a common subject. What do you think? Okay? I want to get an independent person on deferring taxes. Okay. How do you feel about deferring taxes, and how should high income earners think about the opportunities to use a defined benefit plan or a defined contribution plan in some way, shape, or form?
Well, all taxes are deferred. You're not avoiding taxes. You're deferring them to a future date. And I think you should defer them till you die.
Okay.
And the reason being is because you can have good policies in place that can pay off those taxes at a later time, right? You can do that. You can also structure things in the future. You can structure charitable opportunities. You can gift. You can use your estate tax maximization. You can use the right entity structures. Like a lot of what I'm saying is somewhat high level, but nobody expects to be high level until they are. And so like, just think about it. Taxation is literally kicking the can down the road. The only way that you can avoid paying taxes is like literally just evading them, which is illegal. So you have to structurally protect yourself along the way. Like a good example is like if you own real estate right now and you intend to give this to your children or your kin or your heirs, you don't transfer that until you die. When you die, you transition those assets to your heirs tax-free, because as long as it's not above the estate tax, right? As long as that's not the case, like you build, die, transfer everything tax-free. That's the way to do it. And a lot of people think that it's like, well, I don't want to just like avoid taxes and just kick it down the road. I'm like, that's the only way you're going to do it, bro. Like there's no other way. If we could find a way just to not pay taxes without doing anything, I'd be a billionaire right now because if we could figure that out.
Okay, that is a good framework though, right? Because sometimes we think like, hey, what's the difference between saving and deferring? And what you're saying is like at some level, it's all deferral and we just have to continue to defer. And of course, the nice thing is you get a lot of these tools get a step up in basis at death. And so now even though you've deferred it throughout your whole life, you're now passing it on to the next generation, potentially tax-free.
And that, by the way, it's just like, that's just the game, guys. If there was a different way to do it, I would tell you, but there's just not. By the way, anybody who tells you different is full of it. Like anybody who tells you that there's no way, like there's just some magical way to open some fairy dust trust. And that trust is you're never going to own anything, but you're going to control everything. And taxes, you don't even fall into the US tax code anymore. I'm like, dude, chill out. They put Donald Trump's returns out in public about a year ago.
Yeah.
He's still filing taxes. He's still paying taxes. He's still you would think that those guys would be the ones not paying any taxes, right? And us, but then there's some guy that you met at some conference that just said, oh, if you just did this, if Donald Trump just used this strategy, he wouldn't have to pay bullshit. Because you're so much smarter.
Oh, gosh. Okay. Well, okay, so we're getting close to our time. I want to make sure that we hit on what are the things that people should be doing. Actually, let me back up for 1 second. It sounds to me like what you're saying, David, kind of as a bottom line, instead of trying to like save taxes, like we're going to save, defer, whatever you want to call it, taxes to build wealth. And there is a big difference between trying to just like expense something and deferring it and then building. And it feels to me like we're saying, hey, you can play the game. Like that's the important thing. Like you can be part of the game and the game does work, but you've got to go in and play it.
That's right.
Okay.
Well,
okay.
The thing is that money is money. Okay. Like if you make money, you have to either use that money to invest it or spend it. Right. There's only two things. Like you have an investment idea or you can spend it. Right. Even a savings account is somewhat of an investment. But you have to do something with your money. It just has to be used. And if you're using like a traditional tax strategy, which most accountants talk about, it is typically spending, not investing. And spending is not the solution to build wealth. It's just not. It's always investments. And I would venture to guess, even if they did give you an investment advice, it would be put it in a retirement account, which is tax deferred. So,
right.
And in most cases, the way I see it, and maybe your audience feels the same way, I don't put a lot of money into retirement accounts because I don't fully understand what they're doing with my money. Like I don't fully understand it. That's just me personally. I mean, I guess I could figure it out. I'm not ignorant, but I would just say, I'd rather bet on me. Like just let me handle it. Look, if they can give me 10% and I get 8%, but I have all control, I'll take the 8 any day. You know what I mean? Like, cause I got I got it all in my control, but giving my money away to some company that, they're making 3 or 4 points just to say they have it and they don't even know what they're doing either. And they're using some algorithm. Like I'd rather just put it in real estate. I'd rather buy some equipment. I'd rather, fund something for charity. Like that's my decision. But I think most people want to have and build their own thing. And that's just the way I see it.
Okay, very cool. So we've talked about some cool strategies. We talked about the STR strategy, loophole strategy. We talked about the equipment lease. We've talked about even using simple things like tax deferral. Before we go today, David, again, our whole audience is filled with people who need and are looking for what you offer. What should they be doing? What should they be thinking? What's the action item for our audience to kind of continue to move closer to accomplishing their tax goals?
Well, I would reach out to my current accountant or whoever's filing my stuff and really just be proactive in asking them, is there anything that we can do before the end of the year? If you feel like that's the person that can help you. If that's not, then it probably would be a wasted time and, because that's just it. I would really need to know, everybody should know how much they're going to owe. You should always know that. And if you're a W-2 employee right now, look at your federal withholdings and just look at it as a target. because that's a target for you. Like if you look at Fed withholdings and it says 120,000 right now, that's a target. That's like, how do I figure out how to get that back? That's two targets. And then once you know that target, now it's like find the information, find the people who can help me figure that out. And don't be just that's one thing I get a lot from people. It's like, so how much do things cost? How do these things work? I get a lot of times people message me and just like, how much is your service? And I'm like, I'm not an expense. I'm an investment. Like
I like it.
I give you returns. Like if you're really concerned about paying me, you're thinking about the wrong person you shouldn't be paying. You should not be paying the IRS. Like if I can,
Yeah.
so many people think so small when it comes to this. And that bothers me the most when somebody calls me and says, like, how much do you charge? I'm like, I'm not saying I charge a lot, guys, by the means. I'm just saying, does it really matter? Like if you have
the end result, the value proposition is where we need to have our eye on the prize, right? If I can save that much, then if I pay you to do that, then it's a win for everybody. That reminds me, I want to make sure that I hit on this, David. Sorry, I just want to make sure I don't miss it. You told me, and I didn't understand this initially, but you told me that most of your clients or a lot of your clients don't have you do the filing of the tax return. So you can still work with your current CPA. David's not saying, hey, you have to bring everything over to me. He's saying you can still work with your current CPA. I can help provide with the tax strategy that you'll want to implement in conjunction with that. Is that right?
It's 100% right. You got to think about us like you're going to a general practitioner doctor, and then when you have something severe or something wrong with you, they send you over to a specialist. And that specialist works around with your doctor. Very similar concept. We are going to work with your doctor, make sure that you're okay, tell them what we've done, give them the feedback, the results, the regimen, and say, hey, you go back to them for the preventative care. We just handle the big stuff.
I love it. Okay, so if you're somebody who has a tax burden, you just need to reach out to David and his team and have a conversation initially, see what ideas are there, what things you can do. Then you can make a decision, an educated decision at that point. But like the worst thing that we can do is sit on our hands and just pay the tax, right? So I'm super excited to connect with you. Just want to make sure that just a quick call to action again, everybody. The scheduling link is directly in the
chat.
The chat. Okay. And of course, if you reach out to Rod and I, we'll connect you directly with David. So if you're like, oh, I missed it, just make sure you send an email to Rod or Christian at Money Insights Group or Christian at moneyinsightsgroup.com. And we'll make sure that we get you connected with David and his team. I think this has been awesome. Like there's been some like real exciting ideas that I think most people aren't aware of, number one. And I feel like this is kind of just the tip of the iceberg. So my feel from this is that if you go talk to David, you'll end up with lots of good ideas. And the couple that we've talked about are just kind of hitting the tip of the iceberg. David, is there anything you want to kind of finish with before we call it for today?
I would just say, no matter what you guys do, just question everything about question everything about how much you've been paying in the past, because it's truly whatever you paid in the past is probably unnecessary. Now, very clear. If you make over $300,000, in most cases, I can help you. Below this, I'm just going to be very honest with everybody. Under 300,000 is very hard because a lot of the investment activities that we'd recommend may outweigh or may outspend your tax liability. That's just true. So it could be though. I have a client, just for an example, I have a client that just did this, or a new client that just did this yesterday. They were going to pay $38,000 to the IRS or $39,000 towards the strategy. They picked the $39,000, even though it's $1,000 more than they would have normally paid. But now they're getting 18% returns on their money. Plus, they don't have to pay the IRS the money. They get to keep it themselves. So there's going to be a thought process behind this. But I guess last story is just, guys, if you are somebody out there who is overpaying in taxes or just has questions, I'd love to meet with you or talk to you and figure out if there's a way to work together. And secondly, in the last quarter of the year, I can just tell you, it is busy. This is where I'm the busiest. So if you want to meet or talk, we need to do it now, because every month that passes by, it becomes more expensive to do things and it becomes less time to do things. So you don't want to, urgency is of the most importance right now. So if I can help you in any way, you guys are all great people. I know it. So I'd love to help.
Okay, wonderful. Thanks. Reach out to David. Like we said, the scheduling is in the chat box. You can go to us. David, thanks so much for coming on, man. I feel like you've delivered huge value to our audience, and we'll have you on again soon.
Thanks, man. I appreciate you.
Thanks, everybody, for hanging out with us. We'll talk soon.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.